Well, happy Saturday. Happy Valentine's Day, everyone. And here we're with our little discussion group about real estate topics, the investing show. We're going to talk about today about due diligence, and that basically is a process to make sure you're not going to get into trouble. But there's a lot more to that, and I think there's two basic things with real estate investing with due diligence. There's one for people investing in properties, and then there's also many of the people in the room here also invest in mortgage notes, and that's a bit of a different spin on things too. So maybe we can talk about what due diligence is and what the differences are. And anybody want to go first? Alden?
You know, due diligence is basically your risk mitigation at the end of the day. It's all fun and games trying to find an investment strategy, but it's easy to lose money at the end of the day. And if you don't go through your formal processes in order to mitigate your risk up front, you're basically making a bet over making an investment, and what does that look like in various asset classes and things of that nature? If you haven't, getting a formal education is of utmost importance. And a couple of students of the Note Investor University here today, they're a great avenue in order to facilitate your due diligence check boxes, from real estate notes. That's really all your investment is at the end of the day in a note investment strategy is your due diligence, because you're investing in paper, not a physical asset. And I could kind of open it up. What do we think collectively are like the top 10 or top 5 due diligence check boxes that are of utmost importance? What do you guys think?
I agree. Yeah. But go ahead and lay them out.
Top 5 due diligence check boxes, right? When you're evaluating a note to make sure that your risk is mitigated, number one is making sure there's actually a secured lien position on that title or on recorded with the proper avenues. In manufactured housing, it happens to be the DMV. In real estate, you have your I think it's the city office that it gets recorded with. But that's number one, making sure there's actually a recorded position on title. Your taxes and insurance, if it's a performing note, making sure that those are paid, because someone could go into default not paying their taxes, and you could lose your investment not having the insurance at the end of the day. So making sure there's an additionally insured position of the mortgagor on that policy in case of loss. What if the house burns down? What if they anything that, a partial loss, an awning gets rips off the roof? All areas you want to make sure that you're covered at the end of the day. And a paper asset, those are of utmost importance. Number four is the buyer borrower's underwriting. So were they underwritten? Did they go through formal processes to facilitate a transaction? Or did the originator just sit down at a table and sign a napkin, with the buyer borrower? Why is that extremely important? Well, if an individual were just to come and consummate a transaction without going through formal processes, that ultimately adds a negative factor on their ability to repay at the end of the day. You want a strong borrower, you want someone that has gone through formal processes, and that's what underwriting does. And it should come within the collateral file that one gets upon execution of a transaction. So we talked lien position, taxes and insurance, right? Your underwriting, and on top of that, you have your collateral. So, what is the note actually affixed or collateralized by? Is it tools? Is it the actual business? Is it the real estate that's collateralized by the note? In our case, we do manufactured housing, so it's secured to a physical home in the Arizona market. With a buyer borrower performing, paying down that position. That asset, you want to make sure at the end of the day that you know how to execute within that transaction. In real estate, you have your foreclosure processes. depending on if it's in a trustee deed state or not. And those are all implications of owning that note. So making sure your taxes and insurance, your lien position, your underwriting, and the collateral you understand, right? Understanding that asset class is of utmost importance because there's risk in investment. If they do go non-performing, you may end up owning that asset, whether it's the business or the physical real estate or the physical housing unit, all areas of one wants to understand. And that collateral has different benchmarks of how desirable it is. Is it in a good area? What's the absorption rate of the asset like that? And is it in good condition? Someone could come with a note on a non-quality collateral, say it was a manufactured home that was never rehabbed or, out in the boonies, deep in Alabama, on its own lot, all areas to deem a risk mitigation upfront in order to facilitate a successful transaction. Those are my top 5.
Yeah. I'd just like to add to that when you do your due diligence and you do it properly, it gives you a blueprint, an outline of how you perceive this transaction, this deal to play out. And if you do it properly, you work in your profit margin. You see the big picture of what you're going to get out of it. What are you providing to your partners, if you have partners? But it also gives you a vision of where the potential problems could be for this particular property or note. So doing the proper due diligence gives you a great vision of how this deal should proceed.
Very good. Yeah, also, I want to, because as Greg stated, due diligence is a little bit different for, mortgage notes as opposed to other real estate investments. But one of the most important things that I find is that we as investors, we have to get to know the borrower and the payment history. We want to know everything about that borrower, the payment history, the current balance of the note, the interest rate, how it's amortizing, their amortization schedule, and the payment status. If is the person current, or they're paying slowly, or they stop paying, and also you want to verify that asset. If it's tied to real estate, you want to get you want to get that property verified. You might want to do you might want to get a title report, is what I'm trying to say. A title report, so you can see if who's on title, and just verify that the property that you're investing, the note that you're investing in, if it's a case where you're investing in a note, that the collateral is actually what they say it is. And you might also want to, know whether the value, try to get an assessment to see whether the value is in line with what you think you're investing in. Usually, you want the value of the collateral to be more than what your investment is. So just in case things go sideways, you're able to, try to recoup your investment.
Right. And part of that due diligence and in getting the collateral file, you want to investigate the neighborhoods of these where the actual real property lies. You want to understand what what police activity is. Sometimes you want to, for the potential borrower, you want to know that, they have decent schools in there. But I think the police report, the neighborhood information about that, where that note has the property located. So you want to know all these things. You don't want to. I think our mentor gave a story about the bum house, and what it was that when he did the research on that particular note, that there was I'm sorry, it was called a bum tree. There was a tree where all the problem people congregated in front of this tree, which is close to the property where this note was attached. And you want to understand certain things, and this is a part of the due diligence that we do. We investigate the neighborhood where this note is located. So that's one aspect of it. And I find a lot of these stories and things that we do to give more information on things very intriguing. Sometimes they can be very enlightening to the process in which we do our research.
Yes, one of the things I think it came up in with Desi and Patrick was a scenario was a bank was offering a note highly discounted, but it turned out it was attached to a property that had regulations. Basically, you couldn't do anything with it. You couldn't build on it, so it seemed like a value, but it wasn't a value, it wasn't a deal. And that's, regulations can come in. And I think Alden also mentioned environmental risk. Like I'm in an area here where we've had the town was evacuated because of flooding. And then we also sometimes have forest fires. And so there are some properties that are basically uninsurable.
Yeah, making sure that the area that home's in, knowing about the area, the ins and outs of potential development and what's restricted, obviously those all have huge implications. Here in Arizona, we have little to no natural disaster risk, whereas in Florida, obviously that insurance is going to be that much higher of an equation to run within the risk mitigation. If a hurricane comes through and wipes out a bunch of manufactured homes or residential real estate or businesses in that area, obviously the insurance is going to be that much higher coming on their renewal. So, that has a huge implication for sure.
Yeah, and perfect segue, actually. One of the things that we always look at is the property taxes, whether the borrower is current on their taxes, and also the insurance. Is the property insured? Is the borrower making their payments? It's not a deal breaker if they're not making the payments, but once you decide to invest in that property, you're going to want to place what is called force-placed insurance on that property, so that you're insured in case something happens, some natural disaster or some type of loss. You want to make sure that your investment is secure.
I equate note investing to architectural investment. Rodney made the correlation between the blueprint. This is really the blueprint of the entire strategy. And over these, past 14 minutes, we've talked about probably 20 check boxes to go through in order to facilitate a savvy investment strategy. You're not worrying about development risk. You're not worrying about, vacancy potential, when that lease is coming due. or even having to do a landlord moving in and out special, you know, having your blueprint in front of you ultimately helps you evaluate with the collateral file and go through and validate what you're being provided. You know, someone could go on to say like paperstack.com and buy notes and still have the risk to fruition. It be a non-savvy investment, you know, and with these check boxes, they go to these open platforms, even like mobilemailboxmoney.com, and they can verify calculated and take a calculated risk, you know, given this blueprint at the end of the day.
Yeah, that's true. With investing, there has to be a blueprint. There has to be a way of a specific set of rules or, you know, things that you adhere to. When somebody calls it like a buy box, you have to first know what you want to invest in and whether it meets the criteria that you have. You have to have criteria. You just can't, you know, jump into any investment. And once you get that confirmed, then, you know, you can go ahead. But once you get into, make the decision to purchase, I think with a lot of the other points that we talked about before in due diligence, you also, and this is going to be further along, but you want to calculate your yield. You want to know, you know, what your yield is going to be, what your return is going to be on your investment before you invest. So that's a part of due diligence. But you know, you have to know certain numbers. You have to know what the unpaid balance is, unpaid principal balance. You have to know the interest rate, you know, and you know what the original balance was, so you can make an informed decision.
Yeah, that's right. It comes down to basically there are two things. The one is the money going to work? Are you going to make money from what is your return on your investment? And then the other thing is what is the risk? And in both cases, you can mitigate the risk by taking the precautions and knowing what you're getting into. But really, as you said, Courtney, there's no point even looking at it if you're not going to make any money on it. So that's almost the first thing that people need to do is does this deal make sense on from a money point of view?
You know, from the beginning investor, Courtney made a great point. Really, you know, finding out your buy box, what kind of rate and yield do you want to make out in the market, right? And then getting these due diligence check boxes, surfing online platforms, and really building relationships to find those specific assets, and then validating the person who originated the note. You know, that note could be above par or above bar as far as, you know, the legal standpoint. But is that operator actually, you know, operating not out of a bad actor situation? And I think for the new people, you know, that may not have entered into note investments, that really starts to open their eyes. Okay, I want to make an 8% return, or I want to make a 10% return, or really like the gentleman here, I want to raise capital and provide my investor an 8% return. You know, those are benchmarks in the beginning to understand, and then go out and surf, you know, various avenues or people originating notes to facilitate a transaction.
Yeah, and that's why I indicated in the beginning, when you're doing your due diligence, it provides a blueprint. That way you factor in what your profit margin is in the beginning. You always want to know what that is. And if you find in the course of your due diligence that things are not up to par, they have a bad pay history or something like that, there's a problem in the area in which you're buying that note in, you work in your profit margin based off of all the little intricacies that fall short of what you perceive it to be. So that blueprint, the start part, it gives you that picture that you need to make a proper buy box or perfect purchase on that particular note.
Absolutely. I just want to go over some of the documents that are used in due diligence. First, the promissory note. You as Alden mentioned before, you want to have a copy of the promissory note to see how it was written. What are you investing in? What the interest rate is, and the promissory note specify how the borrower is going to repay the note, and it specifies the collateral and everything you want to know in there. You also want the mortgage or the deed of trust. In some areas, you want to put eyes on it. You want to read it through. You want to see if it's the fixed mortgage, or if it's a mortgage that may balloon, or if there's a wraparound, or things like that. So you can understand what are you getting into. You also might definitely want to see the assignments. As I mentioned before, payment history is very important. At least 12 months of if it's a performing note, at least 12 months of payment history. Maybe more if it's a non-performing, to see if there was a specific issue with payments. Then was it limited to a certain time? If there was an issue with the borrower, did they have a death in the family or a hardship, they lost their job, and it's just a temporary situation, or it's something that's been going on for a long period of time. You also want to order a title report. As I mentioned before, title report, it tells you who's on title, who's in first position, second position, that information is very important. Also, I mentioned before, insurance policy. You want to make sure there's an insurance policy and it's current. The status of the taxes, whether the taxes are being paid or not. And this is probably one of the first due diligence things you want to do is an appraisal or a BPO, buyer's price opinion, where the realtor is going to give you an idea of what the property costs based on their observations from the outside. You're not allowed to go inside and take pictures or anything like that, but from the outside, they will give you their estimation of what the value of that property is. You also might want to have the borrower's contact information. So if you have any questions, you contact them. And one more thing that you might want to look at is if there were any modifications to the mortgage. Did the previous investor do a modification for the borrower? Did they, knock off some payments, or they postpone some payments, or they change the interest rate, lower the interest rate, or raise the interest rate, shorten the term from a 30-year to a 20-year. Those are all things that you would definitely want to know as an investor.
Okay, thanks. Yeah, those are all really good concerns and things to look into. Anyway, I want to change tack a little bit here. All three of you buy and sell notes and sometimes properties. And you have an offer, and maybe just summarize what it's like to work with you. Let's say, and I know Alden, you have with Silvercrest Investments and also mobile mailbox money. You have some. You do quite a little bit of background check with the investors, and you have some definite processes. So maybe you could describe what it's like to work with you on that.
Yeah, so I'm blessed to have a couple of my investors actually on today, but I'm Alden Guajardo again. We provide notes to investors that want to earn a passive rate of return, and our notes happen to be in affordable housing and manufactured homes located in the Arizona market. Every note that we originate goes through a formal processes. That buyer or borrower comes to us and we underwrite them first through the community. The community requires a 600 plus credit score, no past criminal convictions, no open bankruptcies, no past evictions, and verifiable income. On top of that, they go through a second round of underwriting to facilitate what's called Dodd-Frank compliance, facilitate their ability to repay. In layman's terms, that means they qualify on a debt to income ratio, credit criteria, and they put all of their credit under a microscope to make sure they can hit an ability to repay. They're actually qualified for that position. Any investor can buy a note. You don't have to be accredited, a non-accredited, or accredited, maybe money in a solo 401k or an IRA, or really just wanting to invest for their LLC or personal investment. All areas of opportunity for earning a double-digit yield, and they can buy a note at mobilemailboxmoney.com. And out of 2 years, we're now out of our infancy of the fund, Silvercrest Opportunity Fund. That's a 506c Reg D accredited investment offering accredited investors a debt strategy for them to participate in the notes that I absorb into my fund at a 10% return for a 1-year term paid monthly, 12% return for a 3-year term paid quarterly, or a 14% return for a 5-year term paid monthly in first-lien performing debt. So outside of complications of developments and things like that. So those are kind of some of the items that we provide out on the market, providing other people the ability to leverage against the notes that we originate and raise private capital from their relationships, or really just start performing in a 30-day program.
No, that's great, and those are pretty good terms and paid monthly. So it really is mailbox money, for sure. So Rodney, do you want? What do you have?
Sure. I do something very similar with like Alden, but I try to make everything a very passive process for my lenders or hypothecation partner. They put up the money expecting a certain return, whether it be somewhere between 8 to 10% returns, but they don't do anything then put their money to work. And I look for people, investors that are seeking a very passive way of doing that. And if they have lazy money, if they have money that's currently earning less than 5%, and that's what the going rate right now for CDs and high yield savings account, about 5%. Roughly, and I think it's actually less than that, but I'm giving you the benefit of the doubt. But even so, if you're earning that amount, you can earn a lot better with the 8 up to 10% returns. So I try to assist other people earn that higher yield. And these are notes that are all over the all over the country right now, but I'm focusing on a certain area in Arizona.
Okay. Yes. By coincidence. Courtney, what do you have to offer here? So, what do you? I haven't really talked to you for a while, so what
Yeah.
Yeah.
So I invest in mortgage notes mostly. I, like Rodney, look for high participation partners, which means that, you know, basically we are always on the lookout for good quality notes, and like we're talking about, you know, today, due diligence. When we see something that's good, you go through it, you go through the due diligence process and see if it fits your buy box. But sometimes we don't always have the money to buy each note that we think is good or that fits our buy box. In that case, you know, I look for an investment partner or a high participation partner that wants to earn above average returns and similar to Rodney as well, you know, maybe 8 to 10%, and they don't have to do any of the work. I'll do all the work, and they don't have to pay me anything either. I'll split the difference with them. You know, they can, if they have money that's earning a lower percentage and they're interested in earning 8 to 10%, you know, I'll pull the trigger on the note, and after I've done the due diligence, make sure, you know, it's something that will work both for me and for the investor. And I'll, you know, set up the automatic payments, you know, right to them. I do have one property that I a non-performing note that I bought that I ended up owning the property because I tried to get it reperforming, but I could not. The borrower wasn't interested in making payments, so I'm dealing with that now, and you know, which is probably going to be a good deal for me anyway, because I bought it at a good price, and I just have to. I already contacted my realtor so I can start getting some eyes on that property, and I may have to put a little bit of work into it, but they'll still work out good for me anyways. But yeah, mortgage notes are mostly my thing.
Okay. Yeah, that is the attraction of note investing, is because when things go south, you end up with the property. So, you know, and if it's if you got a good value on the property and it's appreciating, it can be a good deal for sure.
For you fellas here, you know, out raising capital, I have a note that's pretty low in acquisition cost right now at newly originated here, I believe early next week. The buyer just got approved, and it's a $37,000 note, which is really low for a full seller finance transaction. $37,000. The buyer bought it at $45,000. They're putting an $8,000 down payment. UPB is $37,000. In other words, your acquisition cost for a 20-year term, paying $460.10 a month, $460.10 a month. So maybe I'll connect with you guys after our stream here and send you that information just to give you a little ammo to go out and potentially fish with your contacts.
Yeah, I'm already marketing that one, Alden.
It's on it. Rodney's on it. There we go.
Sounds good. That sounds like a good one.
Yeah. So yeah, so I think for anybody out there, if you're looking to have your money work for you, contact Alden, any of these guys, Courtney, Rodney, and they can let you know how it works in more detail than we've provided here, and what the opportunities are. And Ivan couldn't make it today, but he suggested talking about syndication versus note investing. So that's interesting thing. So maybe that's what we can talk about next week.
Absolutely, yeah. It's a pleasure being here, Greg. You know, you bring on so many industry experts and magnates in their industry. You know, just grateful to be here and add value to the people that may be watching.
Yeah, well, thanks for being here, for sure. All of you. It's really, it's great. I know Rodney was a little bit reluctant, but he always has something very valuable to add to the discussion.
Thank you, Greg. Thank you for the invitation. It's always a pleasure not only to see you in this venue, but I've been watching your music parts too. So keep doing that. It's good to showcase that side of yourself.
Yeah, I'm off. I'm going to play some music at a seniors event in half an hour. I gotta back up and run. And there's somebody who has played a lot of music out but hadn't because her husband had some health issues. But so I'm helping her get back out and performing more. So,
all right,
being the cheerleader for getting people out.
All right.
Very good. Thank you guys for being, I'm just happy to be in company with like-minded people. Thanks for having me.
Yeah. Thanks for coming, Courtney. It's great to see you. All right. We'll see you. We'll see Summer, all of you next week.
All right. Take care of those Valentines.
Yeah. Already.
Oh, absolutely. Absolutely.
Bye-bye.